皆さんこんにちは。ピックジャパンの田中純平と申します。本日は弊社のチーフエコノミストでありますパトリック・ツヴァイフェルと対談をしてまいりたいというふうに考えております。So Patrick, thank you very much for visiting Tokyo today. First of all, our audience is keen to hear your perspective on the United States and the potential impact of Trump policies. Could you share your insights with us?
Sure. Thank you first very much for having me. So the US economy has been growing very strongly for the past 2 years, like above potential. We would actually expect US growth to converge towards its potential. So from current around 3% growth to like 2%. And the main reason for this is because we expect consumption, which had been one of the major drivers of growth, to actually slow down because of 3 reasons. The 3 reasons are disposable income in the US, in real terms, is declining and currently growing at a pace which is below normal. And the second element is that all these excess savings that US households accumulated during the pandemic are now completely exhausted. And the last one is that for the time being, interest rates in the United States are still too high to allow US households to borrow and to support their consumption. So that's the view on the activity side. On inflation, for the time being, we know that inflation is still largely above its target, 3.3 on the core inflation. And I think it's getting a bit stickier. It's getting a bit stickier and will take a bit longer to converge towards its target. And the reason why we expect that is because first, the price of core goods is rising again. It has been the main driver of the disinflation process. And on the service side, we still have strong consumption of services. And the determinants of the price of services are mainly on the labor market. And the cost of labor, so wages are still growing at a pace close to 4%, which is much higher than the 2.5%, 3% that would be consistent with inflation at its target. And companies are still willing to increase their prices. So reason why we expect that inflation to remain stickier over the next few months. Regarding Trump policies, so we group them into 4 dimensions. So fiscal, where we expect it to be more expansive. Trade, which is more protectionism. Immigration, which implies fewer immigrants, and deregulation. And if we want to summarize the impact of those policies on major economic variables in the US, on the activity side, one can say that 2 out of those 4 policies are pro-growth, which is fiscal and deregulation. But trade and immigration are actually negative for growth. So if we summarize the impact, and our simulation would show that compared to the baseline I described before, the risk with Trump policies is that it leads to lower growth. So lower growth than the potential that we had. And on the inflation side, out of those 4 policies, 3 are inflationary out of 4. So we have fiscal, trade, and migration policies that are inflationary. Only deregulation is not. And it's not enough to actually offset the impact of the other 3. So the risk, on top of what I mentioned earlier, is that inflation could even be more or stickier than what I thought.
So it is said that Trump administration has shifted its stance on tariff, emphasizing more on reciprocal tariff. Do you believe this is a fair assessment?
Yes, I do. I think so. So what we know about Trump is that, especially regarding tariffs, that we have new news pretty much every day. So I don't think that, well, first, what I'd like to say is I don't think that reciprocal tariffs make sense on an economic ground, because it clearly goes against one of the major WTO principles, which is to allow emerging or developed economies to have higher tariffs in order to make sure that they can protect some of their sectors and to develop themselves. So that's the first. So it's not fair in that perspective. Now it's fair that he's considering this. The thing is, if you look at the difference between what the US is taxing the imports coming from other countries versus what the other countries are taxing, so the difference is not that big. It's actually 75% of US imports are either at the same tariff or lower. So it's not going to change much. And I do think this is one of the reasons why Trump has considered to go beyond the reciprocity and to include VAT.
And how might the Fed respond to these circumstances? And have the Fed officials adjusted their tone regarding its monetary policies?
Right. So given what I described earlier, which is a US economy which is still resilient, with inflation which is still above target and not unlikely to converge soon towards its target of 2%, it makes a lot of sense for the Fed to remain in restrictive territory. The question that FOMC members have is, what's the limit of this restrictive territory? And usually, we take this limit as being defined by the neutral rate. A neutral rate is by definition where you should be if growth is at its potential and inflation at its target. So they should remain above that level. Our own estimate for the neutral is around 4. Models would say it's more around 3.7. And FOMC members for the time being have 3. So if you believe their own median, they still have room to cut a lot. But what I do expect is that most FOMC members will revise up their neutral rate. And I think there's limited room for the Fed to actually cut rate and to make sure that they remain in restrictive territory for a while. So we do expect only 25 basis points cut this year versus market expectations, which are a bit higher than that.
Interesting. Okay, now turning our attention to Europe, there are ongoing negotiations between the US and Russia aimed at ending the war in Ukraine. So, although there's still a long way to go, what could be the implications for the European economy if the conflict is resolved?
Right, that's a very interesting one, and I think this is happening in a context where the Eurozone economy is recovering. So, unlike the US, which had been growing above potential for 2 years, Eurozone has been flirting with recession for 2 years. And what we have seen lately is the start of a recovery, which is driven by domestic factors such as consumption. Consumption had been in contraction for the past 2 years as well. And now we've seen retail sales typically for the Eurozone growing at a pace which is above its normal level. So there is this recovery. And I think this recovery is linked essentially to 2 factors. And again, to compare with the US, I mentioned that they have exhausted their excess savings, while in the Eurozone, they still have this huge amount of savings. And it had continued to grow over 2024. And there are 2 reasons for this savings to actually be that big. The first one is that for the first time in a long time, they had decent positive interest rates on their bank deposits. So instead of spending now, they decided to save because of those high level of rates. The good news, for consumption, is that rates have started to decline in the Eurozone. And if you look at the evolution of bank deposits, it's down. So they just withdrawing and to spend. But the other aspect linked to your question is that actually people save not only because of rates, but also because of uncertainty. As we know, geopolitical uncertainty has been huge since the beginning of 2022, forcing European households to save and to save even more. So I think one of the major impacts that some sort of a ceasefire between Ukraine and Russia could have is to reduce those savings and to boost economic growth in the Eurozone. That's for the economic implications. One word maybe on a more structural basis is what this could have in terms of impact for Europe. And I guess given what we just had and the fact that Trump is negotiating directly with Putin, excluding Ukraine and Europe from the negotiations, it's the first time that Europe hasn't been invited to the table to negotiate when things happen in Europe. So it has been perceived by European leaders as pretty offending. And one element to watch is whether what Trump is currently doing could actually push and force the European countries to unify more. And that has stronger long-term implications.
So, okay, our next question is about China. It is widely believed that Chinese economy is weakening due to its real estate sector. What's your take on this?
That's correct. I think starting with the real estate sector, because you mentioned it, the peak of the real estate sector in China was February 21. And if you look at what happened since then, so when I say the peak, I'm essentially looking at the demand for residential spaces, and those demand had collapsed by 60%. But for about a year now, we've been pretty much flat. So it's clearly weak, 60% lower. There's no reason for an immediate recovery. But the good news for the Chinese economy is that this is not going to be a drag on growth anymore. I mean, the collapse has been done. And if you look at the demand for those residential spaces, they're actually slightly up on a year-on-year basis. So it's still weak, but not contributing to more depression on the Chinese economy. And I do think that a bit similar to Europe, that the recovery that is taking place is underestimated by investors and by markets, because there's a lot of focus on the real estate, but there are so many positive factors that drive the Chinese economy. So obviously it has been largely driven by exports, which are at risk with Trump tariffs, but there's other components such as consumption, which is again often underestimated, because people in China tend to focus on retail sales, which is only part of the story. Because if you look at the consumption of services, the combination of the two is actually growing at a pace similar to the one of the GDP, around 5%. So it's still quite okay. And this is where you could see upside surprises in China. And the last driver of Chinese growth has been investment by the manufacturing sector. Obviously largely subsidized by the government, but it has been growing at a pace largely above normal, especially in sectors such as green energy, so including solar panels or lithium batteries, EV vehicles, and on top of that, semiconductors, obviously. So there's many elements that could actually argue for a more constructive view in China.
I imagine it could benefit other emerging market countries as well. Maybe.
Oh, that's absolutely right, because China is, in terms of size, is about half of emerging markets. And the trade between emerging markets and China is, for a lot of those emerging countries, China is the first trading partner. So obviously, if China maintains a growth around its potential or slightly above, that will definitely support the rest of the EM. Agree.
So lastly, Japan. So the Japanese economy grew by 2.8% Q-on-Q annualized in Q4 2024, surpassing the consensus of 1.1%. So could you share your perspective on the Japanese economy as well?
Sure. So that's one area as well where we are rather constructive, with views that tend to be slightly above consensus. especially on activity. So our own growth forecast is 1.5% for next year, which is double the estimate of the potential growth rate that we have for Japan, which is around 0.7. So it's clearly a strong recovery given Japanese history, obviously, and which is again essentially led by consumption. So pretty much a similar story as the Eurozone, but with another driving factor, which I'm sure you've observed and you know that there are a lot of visitors in Japan right now. You've reached a peak in terms of 37 million people visiting Japan a year, and obviously this contributes to better consumption data as well. So that's on the activity side, optimistic there, and optimistic on inflation as well, in the sense that we do indeed expect inflation to converge quite rapidly to the 2% target. And one element behind that is the stabilization of the yen, which had been one of the major driver of the uptrend in inflation in Japan.
But can Japan withstand the pressure of rising inflation and interest rates? Because obviously Japan have not witnessed this for the last 30 years. What do you think?
Right. I think it goes back to the argument that I just mentioned earlier, is consumption is doing well. So it means that inflation doesn't look like to be a big headwind for Japanese households. And the main reason behind that has been obviously all the wage negotiations that take place in April each year, which have in general largely adjusted for these higher inflation rates. So on the impact that inflation can have on consumption, I think that this is very limited and actually quite positive, because real wage are growing in positive territory. And the impact of high rates, and I would again use the argument of inflation, is the impact of those rising nominal rates. If you look at the long end of the curve, which is what most companies would take as a benchmark for their own borrowings, in real terms, it's still negative. So obviously it has risen a bit, but we still haven't reached level that start to become a threshold for companies to borrow. So. And again, looking at the latest indicators that tend to be good proxies for investment, such as machinery orders or those kind of things, they're actually rising at a pretty fast pace. So meaning that I don't think it's a concern indeed.
So last question about BOJ. I think investors are concerned about BOJ raising its benchmark interest rates above 1%. What's your view on BOJ's monetary policy?
So the short answer is our own projection is for the BOJ to increase to 75 basis points. So less than market expectations, less, and obviously not above 1. And I think the main reason is that we have this view of a declining inflation rate thanks to stable yen. And we also share the view that we can hear from some of BOJ members, that Japan has been waiting for such inflation rate for such a long time, that at current level, they don't see this as being a big risk for the Japanese economy.
Well, thank you very much for your time today. Very helpful, great insights.
Thank you very much.